When the market rose all the way and suddenly fell, did you feel that the main force was going to run away? As a result, the market often takes off again as soon as it leaves the market. In fact, this is just a normal callback in the trend. If you can't tell the difference between back and reversal, you are likely to miss the main trend and can only make a little money. And what is callback? In human terms, the return is a breathing decline in the upward trend, or a rest rebound in the downward trend. Just like climbing the stairs, no one can climb to the sunshine floor in one breath. In the middle, they always have to stop and take a few breaths, and even take a step back. This is the callback. Core definition: the callback is an inverse fluctuation within the original trend, which will not destroy the fundamental structure of the trend. And the reversal is a fundamental change in the direction of the trend at an inflection point. In an upward trend, the decline in the box areas no and nowhere is called a callback, because the price hit a new high later, and the trend has not been destroyed. However, if the price falls below the starting point of the trend, the return may turn into a reversal. For example, if the nose area falls below the starting point of the B section, it will become a new downward trend. Yay, the essence and understanding of the callback. First of all, we need to establish three core understandings of callback. The callback is the natural rhythm in the trend operation. In a clear period of rise, the phased decline of the price is usually the process of natural adjustment of the position structure within the market. It can be understood that some position holders choose to leave the market in stages, while at the same time, new funds are looking for an opportunity to enter. This interaction prompts the price to be sorted out for a short time, which is an important link to achieve the healthy continuation of the trend. The trend of lack of sorting is often not stable enough. If the price always moves quickly in one direction and lacks the necessary price sorting and digestion, the foundation is often not solid enough. This usually means that the kinetic energy is excessively consumed, and once the follow-up force cannot be continued, the trend is more likely to change rapidly. A stable trend often consolidates the foundation through multiple callbacks, so as to go further. The premise of the callback is that there is a clear trend background. The callback is for the main trend. Only reverse fluctuations in a clear upward or downward trend have the significance of discussing the callback. In the sorting market without a clear direction, the up and down fluctuation of the price is only a range shock, which does not constitute a return under the trend framework.
Common manifestations of callback distinguish according to the magnitude of withdrawal and status. Lighter pullback, the price only retreats to a smaller proportion of the increase in the previous wave, and the time is relatively short. This usually shows that the power of the dominant trend is still strong. Retreat to the key proportion of the pullback. The price falls back to one half of the previous wave of the increase, or the golden ratio area. This is a key area that the market is generally concerned about, where the multi-empty force may reach a phased balance. The complex arrangement of time for space. The price fluctuates repeatedly within a relatively clear range for a period of time, digesting the pressure through the extension of time, replacing the deep price pullback. Distinguish according to the stage in the trend. The backward adjustment of the trend development period. It occurs after the trend is established and before the accelerated operation. The overall momentum is abundant, and the probability of running in the original direction after the return is high. The callback in the second half of the trend. At this time, the price has often run to a large extent, and special attention needs to be paid when there is a return. If it is accompanied
how to distinguish between callback and reversal. The reviews method. It is impossible to predict 100% in the transaction, but the probability of judgment can be improved through the 3 loops framework. Look at the amplitude and key position. Feedback usually does not effectively fall below the starting point of the previous wave of trends or importance apart. Pressure levels, such as moving averages, early high and low points. Reversal. It will fall below, rise through the key position strongly, and the rebound will not be able to stand back again. Look at the structure and kinetic energy. Retrend. In the upward trend, the downward K line at the time of the callback is often smaller and weaker, and there are stop-loss signals such as the lower shadow line. The opposite is the case in the downward trend. Reversal. There will be a strong reverse K-line combination such as swallowing pattern, island reversal, and the fluctuation amplitude and trading volume will be significantly amplified. Look at the background and the general trend, the most important. Always look to the left first. Where is the current trend in the larger cycle? If the large cycle such as the weekly line is a strong upward trend, then the decline of the small cycle such as the hourly chart is very likely to be a return. If the price has experienced a long-term and drastic increase and there have been many deviations from the top, then the current decline is very suspicious that the starting point of the reversal is high. IV practical application. How to deal with callback for position holders. Unless there is a clear reversal signal, they should embrace the callback and endure reasonable fluctuations to avoid being washed out of the game by small shocks. You can use the callback to increase the position pyramid style. For onlookers, the callback is a good opportunity to enter the trend. Look for long opportunities near the support level of the upward trend, and look for short opportunities near the rebound pressure level of the downward trend. Risk management. Set the stop loss below the key position when long more than when short. If the price effectively falls below, rises below this position, it means that it may not be a callback and should be stopped decisively. V-case review. Take a classic V-type reversal as an example. Initial rise, the price rose from point A to point B, and the trend is good. The first decline, point C, fell back from point B to point C, did not fall below point A, and then rose again to a new high to point D. This BC decline was confirmed as a retard. Second decline reverse, the price began to fall from point D and fell strongly below the previous low point C and the trend starting point A. At this time, the background has changed. Point D may form a double top or top deviation. This decline was confirmed as a reversal, opening a new downward trend. Conclusion: the callback is the breadth of the market and an indispensable part of the trend. If you are afraid of a backward adjustment, you will miss the main trend. The key to improving the trading pattern is to understand the callback, identify the callback, and make good use of it. Only by developing the habit of looking at the background of the general trend first and then looking at the details of the moment can we rise and fall without being alarmed and truly grasp the wave of the market that belongs to you. Keyman method. In the trend, the callback is a friend. In the shock, the fluctuation is a trap. Always ask yourself first, what is the current market background?